Okay, moving on. Now, other issues, just like purchases side, we may have returns allowances. For sales side, your customer may also return some of the goods, and you may be granting them an allowance to reduce their liability, reduce the accounts receivable that you're getting from them if the goods are damaged in the middle. So it's likely that these two cases would happen, just like how we talked about this on Monday for purchases side. Now, the only difference here between this cycle and purchase cycle is that, remember in the purchase cycle, everything is captured under inventory account. For sales side, we do have sales returns allowances and sales discounts, two different accounts to capture this. Why? Because under income statement, remember income statement is all about revenue and expenses. This sales revenue is a very important account. It's pretty much the only account that you will see the majority of the income coming from. This usually if it's a sales business, they wouldn't have as much service type of business revenue generated. Okay, so sales revenue, we want to capture this in much details. You will first list the original sales amount, but then any other issues that happen, you want to list it subsequently in other accounts right next to it under the income statement. Okay, so we do have a separate sales returns and allowances. We have a separate sales discount account to capture these two events in case it happens. You will see the dollar amount listed there. Okay, so this gives outside users also more detailed information in terms of where the revenue comes from and why is it reduced later on because of these issues. What is the percentage of the amount under these two accounts? Under the account of sales returns and allowances. Okay, now another difference is that returns and allowances, returns has actually the goods from customers shipped back to you. Allowances, we don't keep track of the goods. You may ask the customer to hold on to the goods, but you still grant them a reduced amount of accounts receivable. Okay, but for the first case here, if you do have returns, actual goods collected back, this will also influence your inventory value. Okay, inventory value will go up. For return case, allowances would not have inventory value affected. Okay, so the next slide I'll be showing you the entry. The general idea here is that both returns and allowances will allow customer to pay less back to you later on. If earlier you thought you provided goods that were worth $1,000, then they returned $100 worth of inventory, then they only need to pay you back $900 later. Or they didn't return to you, you grant them a reduced amount because the goods is completely damaged, then they still only need to pay you $900. So both cases affects the accounts receivable that we're collecting from them.
What if they become a full refund? How would you, journalize that?
Company, if it's completely damaged, you mean the entire $1,000, that's also possible. So we're talking about the case of partial. But of course, that's between how the seller evaluates this particular event. If the whole thing is completely damaged, then of course it's possible for an entire full refund. Okay? So both cases, with or without the inventory actually shipped back to you, you'll be granting a reduced amount of accounts receivable that a customer will be paying your company. Okay, but in terms of transactions, returns will have